Okay, let's do a little forensic analysis here. We're about to break down a trading algorithm that somehow turned a pretty small deposit into a multi-million-dollar fortune. Sounds like science fiction, right? Well, the data tells a fascinating story. Let's follow the clues together and see what we can find.
So right out of the gate, look at this. This is our first piece of evidence, the equity curve. It's basically the account's life story, starting from just 10 grand over several years. But what's really stunning is just how smooth that climb is. There are no terrifying, heart-stopping nosedives, just this steady, relentless march upward. It's the kind of thing traders dream about, and honestly, it almost looks too good to be true.
And where did that incredible climb end up? At over $2.9 million in pure profit, all from that initial $10,000. So this is the big question we're tackling today. How on earth is something like this even possible? The answers? Well, they're hiding in the data, and we're about to dig them up.
All right, to crack this case, we've got to start with the numbers. We're going to dive right into the raw data, the DNA of this algorithm's success. Let's see what the stats have to tell us.
Okay, here's the whole shebang, the full performance report. Now, we're not going to get lost in all the little details. Instead, we're going to zero in on the key metrics that really give away the algorithm's secrets. And the first thing we're going to look at is something called the profit factor.
So what exactly is profit factor? Well, it's actually a really simple but super powerful idea. It just tells you how much money the strategy makes for every single dollar it loses. Anything over 1.0 is considered profitable. Obviously, the higher that number is, the better.
And this algorithm's profit factor is a jaw-dropping 2.47. Think about that for a second. For every single dollar it lost, it made back almost $2.50. I mean, that's not just a slight edge. That's a massive, massive advantage over the market.
And this slide really shows you the raw power behind that number. Let's be clear, this thing wasn't perfect. It did lose money, almost $2 million in losses. But look at the other side. Its profits were more than double that, coming in at nearly $5 million. It's just a classic case of winning way bigger than you lose.
Okay, get ready for this next number, because it's kind of hard to wrap your head around. Out of more than 37,000 trades, this thing won 88% of the time. Let me say that again, 88%. That means almost 9 out of every 10 trades it took made money. This incredible consistency is the real engine that drove that beautiful, smooth growth we saw earlier.
But, a super high win rate like that can be a trap. It makes you wonder, was this algorithm just a reckless gambler? Was it making a ton of super risky bets that just happened to pay off? Was it just one bad trade away from blowing up the whole account? We need to look at the risk.
Well, this number right here. This is the answer. The maximal drawdown, which is the biggest peak-to-trough loss the account ever suffered, was just 0.67%. That's it. Less than 1%. So this wasn't some reckless gunslinger. This was a cold, calculated, and ruthlessly efficient machine that hated losing money.
Okay, so we've established it's crazy profitable and surprisingly safe. But what's its personality like? When does it actually do its work? To figure that out, we need to look at when it trades. Let's see what its daily schedule tells us.
So check this out. We're looking at its daily routine here. The charts on the left and right show a massive spike in activity and in profits between 4 p.m. and 10 p.m. This thing is clearly built to wake up and hunt for opportunities right when the U.S. market is at its busiest, during the open and close. It's a total creature of habit, and those habits pay off, big time.
Now, if we pull back and look at the whole year, another really interesting pattern pops out. Its performance isn't just flat across all 12 months. It has these hot streaks, you could call them, especially in March and April. This kind of hints that it's tuned to take advantage of very specific market conditions, maybe seasonal trends or certain types of volatility that only show up at certain times of the year.
All right, we know what it is and when it trades. But to really get it, we need to go microscopic. We need to dissect its individual moves. Let's put a single trade under the microscope and see what we find.
This chart here is a huge piece of the puzzle. It plots the profit of every single trade against how long the trade was held open. See how almost all the dots are jammed up on the far left side of the chart? That tells us something absolutely crucial. These trades are incredibly short. This isn't long-term investing. It's more like a series of lightning-fast raids on the market.
And the exact number is 2 minutes and 11 seconds. That's the average time this thing held a trade. This is what traders call scalping.
It's designed to just skim tiny little profits off the top, getting in and getting out before the market even really knows what happened.
And all of this boils down to one simple but absolutely brilliant philosophy. If a trade isn't working, kill it immediately. If it is working, let it do its thing. It's just a masterclass in trading discipline, executed by a machine, and it's really the secret sauce to its incredible success.
Okay, so we've gathered all the evidence. We've followed the clues from the big picture down to the tiniest detail. Now, let's step back and put together the final profile of this remarkable trading machine. So, what's the final verdict? We're looking at an algorithm with an extremely high win rate of 88%. It operates with incredibly low risk, never losing more than 0.67% of the account. It does this by making thousands of ultra-short-term trades that last, on average, just about 2 minutes. And it all works because of its ironclad discipline, taking profits and cutting losses with surgical precision. It's a perfect storm of profitability and control.
And all of this leaves us with one really big question. Are we looking at the future of finance right here? A glimpse of what AI can really do in the markets? Or is this just a backtest, a perfect simulation of the past that might just fall apart when it faces the messy, unpredictable future? We've seen the what and the how, but the ultimate question remains. The data's all there, so what do you think?